Let's dive right into this explainer and actually check under the hood of India's massive manufacturing economy. We hear a ton about India's booming growth, right? But to really understand what's happening down on the factory floor, we've got to look way past those flashy headlines and dig straight into the hard data.
So look at this number, $16.06 billion. What's absolutely fascinating here is that this represents the immense capital already poured into India's Production-Linked Incentive, or PLI scheme, by August of 2024. And get this, that's just a fraction of the over $23 billion expected to roll in soon. The Indian government is literally throwing serious financial weight behind its manufacturing sector. Today, we're going to unpack exactly how that's playing out in the real world.
Here's our roadmap for today. We'll start with India's manufacturing master plan. Then we'll track the economic pulse, hit a bit of a speed bump, compare infrastructure versus consumption, and finally look at what lies ahead.
All right, Section 1, India's manufacturing master plan. Let's look at the grand vision.
The sheer scale of ambition we're seeing here is, well, it's pretty awe-inspiring. India is actively aiming to build a globally competitive domestic supply chain ecosystem from the ground up. I mean, over the past decade, the manufacturing sector has definitely expanded, but now the momentum is really accelerating. Fueled by foreign investment, the game plan is crystal clear. Capture the relocation strategies of global manufacturers who are actively scrambling to diversify their supply chains beyond China. To make this happen, the government rolled out the PLI scheme across 14 target sectors. And this breakdown perfectly illustrates exactly where the big money is flowing. Automobiles and mobile manufacturing are totally leading the pack to fuel long-term industrial capacity. Just look at that, $6.7 billion earmarked for auto, $4.8 billion for mobiles, and another $2.1 billion dedicated to advanced chemistry cell batteries. They are heavily, and they mean heavily, subsidizing the industries of tomorrow. Now, the human impact of all this investment? It's profound. It pushed total employment in the organized manufacturing sector to nearly 18.5 million workers by the 2023 fiscal year. The sector completely clawed its way back from the pandemic dip, adding nearly 1 million workers above those pre-pandemic levels. That is a massive recovery. Moving on to Section 2, tracking the economic pulse. Let's check the dashboard.
Before we dive into the charts, let's quickly define our core metrics. First up is the PMI, or the Purchasing Managers' Index. Think of PMI as giving us the immediate temperature of business conditions based on what's happening on the factory floors right this second. It's basically a survey sent out to companies asking, hey, how are your new orders, output, and employment? Anything above a score of 50 means the sector is expanding. Simple as that.
Our second metric is the IIP, or the Index of Industrial Production. So while PMI is all about survey-based sentiment, the IIP is our hard coal data metric. It tracks the actual physical volume of goods being produced across the country's mining, manufacturing, and electricity sectors. All right, look in here. You can see the PMI is firmly planted in the expansion zone by January 2026, and that's driven by strong domestic demand and faster output growth. Notice how the blue bars representing manufacturing consistently hover well above that crucial 50 mark. The companies surveyed are literally reporting that input buying and inventories are rising just to meet these higher production needs. Sentiment right now is remarkably strong. But here's where we start to see a bit of a disconnect. While those orange bars of the PMI show sky-high sentiment, the blue line representing actual IIP growth is starting to dip. You can see how the blue line peaks and then sort of drifts downwards toward the right side of the chart as we get into early 2026. The optimism on the factory floor isn't perfectly translating into explosive physical output across the board. Kind of makes you wonder, right? Which brings us to Section 3, a bump in the road. We're definitely hitting a speed bump here. These numbers tell a pretty sobering story of deceleration. By March 2026, industrial output growth hit a 5-month low of 4.1%. That shows a really clear moderation from a strong 7.8% back at the end of 2025. Now, to be fair, the sector is absolutely still in expansion territory, but the overall growth momentum has undeniably eased off the gas. So, what exactly caused this dip? Well, while mining remained solid and manufacturing held a decent pace, softer demand and the disruptions from the West Asia crisis severely tapped the brakes on electricity generation. Power generation expanded by barely 0.8% in March 2026. That is a steep drop from the 7.5% growth we saw in the same month the previous year. It essentially acted like an anchor, dragging down the overall industrial average. All right, Section 4. Infrastructure versus consumption. Let's really look under the hood. If you're an investor or honestly just someone trying to wrap your head around the Indian economy, this is the divergence you absolutely need to watch. When we break down the January 2026 data by exactly what is being used, we see that infrastructure and construction goods surged by a whopping 13.7%. But on the flip side, consumer non-durables, everyday essential items, actually contracted by 2.7%. A recent Cantor Bank research report hit the nail on the head. They noted, growth is currently investment and infrastructure-driven rather than consumption-driven. Government spending on roads, railways, and massive public projects is keeping the factories humming. But everyday private consumption, it's visibly lagging behind. What this essentially means is that the heavy industrial engine is revving hard for these massive projects, but the everyday consumer just isn't buying enough basic goods to match it. Industries pumping out basic metals, commercial vehicles, and cement are seeing fantastic numbers. But that contraction in non-durables, that points to a real, undeniable softness in rural and mass market demand across different income segments.
So where do we go from here? Section 5. What lies ahead?
This divergence brings us to our final piece of the puzzle. Look at this. Bank lending to the industry is expanding rapidly at 12.1%, but actual core production is only growing at 4%. What this tells us is that credit is definitely flowing freely. Companies are borrowing heavily, likely for working capital or long-term infrastructure projects, but that money hasn't fully translated into immediate, broad-based physical output just yet. There's a lag. To summarize our key takeaways here, financial conditions are highly supportive, but the real-world manufacturing momentum is still trying to stabilize and catch up. Government capital expenditure is basically acting as the anchor for the entire sector right now. Private investment is recovering, sure, but it's a gradual process. And perhaps most importantly, retail and rural demand absolutely requires our close monitoring moving forward. Credit is flowing, and infrastructure is absolutely booming. But will the everyday consumer catch up? That is the multi-billion-dollar question, and it's the one that will ultimately define the long-term success of India's manufacturing boom. Building the factories and the infrastructure, well, that's step one. But a truly self-sustaining economic engine requires a thriving, consuming middle class to actually buy what those factories produce. So will the consumer catch up? We'll be watching the data closely to find out. Thanks for joining me on this explainer, and I'll catch you on the next one.